So a very good morning to all of you for joining on this special webinar. Uh, Coincidentally, special webinar is on special situations only. And we have with us Vikas Kasturi. So let me just introduce Vikas Kasturi here. So Vikas is a very dear friend and we have discussed on several ideas since last 2-3 years. And he's kind enough to help me even in my earlier when we started Mission Smile. So I owe a lot to him, and now he's also a Mission Smile member. So that is an added advantage we have, right? So let me just give a very brief introduction. So Vikas has worked for 13 years at Infosys. His last role was as a product manager of a big data recommendation engine. He now works as a full-time investor and he likes to find high quality compounders as well as special situations. Okay, so basically he is focused on these two areas only, right? And let me just give you a few examples. Vikas had invested in companies like BSC and IEX way ahead, way before it caught markets fancy in 2021. So he was invested in them probably in the so he invested in IEX just before COVID, and BSC also I think near about the same time, right, Vikas?
2019. So both
Exactly.
I started investing in
2019. Great. So before I give the presentation to Vikas, I always keep referring to this quote from the movie The Prestige, which is by Christopher Nolan, and it is about two magicians competing with each other, and one of the magician in that movie says, "Sacrifice. That's the secret of a great trick." So he talks about sacrifice. So I don't know whether Vikas calls it a sacrifice or not, but Vikas is not on social media. So had he been a social media person, he would have probably had 500,000 followers by now. But he has carefully chosen to be not on social media so that he can focus more on his art.
Okay.
And his art is in finding the investing stocks, right? And let me just give one example of his research, which probably. Hello.
No voice recorder.
I would request everyone to be on mute. There is some noise. Okay, so I'll just share one. Can you see this? My screen? Vikas, can you see the screen?
Yeah, I can see.
So this is Dr. A. Velumani, erstwhile owner of Thyrocare, as in he has sold his stake very recently. And this is what Velumani wrote about Vikas. I'll just read what he wrote. Do not think even a 20 plus years experienced Thyrocarian knows about me in this detail. Someone who I have never seen or met or talked to has written this. Read it 4 times in the last 12 hours. It is pretty much long shot. So I'll just share the link of the tweet, and also I'll also share what Vikas wrote. I'll probably share the link of his blog post, and you can probably see it later on. Okay. So now with this, I would request Vikas to start the presentation.
Yeah.
And all over to you, Vikas. I'll be on mute.
Let me know when you can see my screen, okay? Is my screen visible?
Yes, Vikas, I can
Hello?
see you.
Yeah,
You
okay.
can go ahead now.
So, yeah. So, first of all, wish you all a very happy new year. Uh, and first of all, thank you, Ankit, and thank you, Karan and Akhilesh, uh, for inviting me to speak and present on this topic. I mean, because I was presenting, I had to learn and relearn a few other things. Uh, I mean, which wouldn't have happened if this presentation wasn't there. So, thank you for giving me this opportunity. And I also want to thank all of those who are present here, and especially the ones to attend this, right? I also want to appreciate the fact that you had many different ways in which you could spend your Saturday morning. And thank you for giving some of your time and your attention to this presentation. You are in a way you are like a good or a great value investor, right? Already because you are thinking more in terms of upsides and downsides. The downside is you'll probably lose 1 hour of your time, but upside is you will probably get to learn something new, right? And this is probably a great attitude to have with respect to a lot of things. Um, so, so thank you very much for giving me some of your time and attention. I will do my best to do justice to your time and your investment. Um, so please, if you feel dissatisfied in any way, if you think it's not worth your money or something, please get in touch with me. Um, so I just so the special situation in investing, right? There was this presentation by Gaurav Sood on India Investing Conclave, right? I would urge each and every one of you to please go and watch that. So that was a fantastic presentation, and I have watched it 4 5 times maybe, right? And I try to like Ekalavya, right? So I try to go and apply whatever he said in those videos. I try to find situations that are similar to what he's talking about, and I apply it. So unfortunately, there are not too many Guru Dronacharyas around who are willing to share or mentor or show the way, right? So I'm going the Ekalavya approach, and I'm using whatever Gaurav Sood had presented. So my request to each one and everyone is it's a free video. It's on India Investing Conclave. I have shared the link in my presentation. Please do visit that video if this interests you, right? Uh, so with that, I will start. Yeah. So a few disclaimers. So whatever I have to share today is my own opinion, right? And it is not those of SmartSync, right? So the names of companies that I've used for illustrative purposes, I am still invested in a couple of them, and please, please understand that I could be biased. My opinion here could be biased. I am not a SEBI registered investment advisor or a financial advisor. And so please do your own due diligence before you uh, uh, invest through special situations, right?
Vikas,
And last,
I think you can probably try switching off your video because there is some
sure.
problem with the internet connection maybe from your side.
Okay, just 1 second, Ankit.
Or is it only me? Everyone can listen him properly?
Yes, sir, we can listen.
We could listen to him. Okay, then Vikas, then continue the way you were. You can
Okay,
continue with the video.
no problem. I've just turned off my video. If anybody wants to see me, I will turn it back on. So last point is quite important. See, my experience in special situations is limited to about 3 4 years now, and please do not attach too much weightage to what I am about my opinion. I hope to just show you give you a good uh, sort of show you the lay of the land, and this is what it is, and so on, right? And if you decide to invest in special situations, then please do read some of the books and those articles, and watch Gaurav Sood's video. I think those would be a great start. Okay, all right. Um, yeah. So, what is special situations investing, and why invest in them? See, the difference between long-term investing and special situations is that in long-term, I'm betting on the growth of the business, right? Whereas in special situations, I'm betting only on the corporate event, which is going to happen or likely to happen. But the broad principles remain the same. I am I'm trying to buy cheap, and I'm trying to buy.
Request everyone to be on mute.
Yeah. So, and you want to buy with a margin of safety, right? Um, so these are the same principles with which you invest in long term, and it works in the same thing in the short term. And so, why invest in special situations? So, first one is it gives you much better returns than FDs, right? Um, so in today's world, so FDs give you somewhere around close to say 5%, right? Um, uh, so when I was preparing for this particular uh, uh, presentation, right, that's when I have okay. So luckily, what I have done is I've tracked every transaction I have done. I put it in an Excel sheet. Every buy, sell, dividend, everything I put it in an Excel sheet. So when I was preparing for this, I said like, look, somebody might ask me this question. So you're saying it is better than uh, FD. So what kind of returns have you gotten? So with my limited understanding and with a lot of luck, my returns have been somewhere in the 33% CAGR. Okay. So this is not an indication of what it can do, right? So you could probably get much more than that, right? Or if luck doesn't favor you, even though you may have done a great thing, it could be lower than this, right? So that's why I said it's not it should not be an anchor. Uh, and the other important thing is, see, irrespective of whether it's a bull market, bear market, you will find opportunities in special situations, right? Uh, or you may have just sold a big position of yours, you have some cash, and you want to wait for prices to cool down a little bit. If you find special situations, you can deploy it there, right? So in a way, it acts as it's complementary to your long-term investing. And usually, short special situations work out in about a few months to a few years. Okay. One other thing is, um, see, when you invest in special situations, it will force you to learn a few things which you wouldn't bother otherwise. So, for example, what is the SEBI takeover code? What does it say? Uh, what is the process of delisting? Right? Uh, uh, right? And so things like this, you will be forced to learn some of these things because you invest in special situations, right? And it is in a way complementary to your long-term investing too. So, for example, uh, so if you are into say playing, so let's say if you are into jogging, for example, and you want to keep yourself fit. So, if I told you to do yoga, would it hurt you or would it help you? I would think it would help you, right? So special situations is like that. It's a complementary way of investing. It uses the same principle, except that you are betting on slightly different things from what you would in your long-term investing, right? So this is just pretty much the same thing. So long-term investing is like watching paint dry, like somebody said, right? So it's like it could be pretty boring. So for example, last month, Ankit presented on Eicher Motors, right? So, what do you do between two Eicher earnings calls, right? What else is there to do? right? You have to, you can probably look at the number of units that they've sold in exports and how many they're spending on, how many stores they're setting up and so on, right? But essentially, what else will you do, right? So on the other hand, special situations investing is like that skydiving thing, which adds a little bit of excitement to your life, right? So, so I like that. I like to do both. I like to get bored and I like to do a little bit of skydiving, right? So, and so these are some of the famous practitioners that I know of. There is Warren Buffett, Professor Bakshi, Joel Greenblatt, and Gaurav Sood. So I think it was Avadut who was talking about Joel Greenblatt. So he's written a book called "You Too Can Be a Stock Market Genius," right? And at the last page of the book, he gives his CAGR, which is close to 50% CAGR over 9 years or something, right? A lot of it through special situations, right? And I've already mentioned Gaurav Sood. So he's an investor based out of Gurgaon, and I think he does both long-term and special situations. So his video on IIC, I've provided the link. Please go and take a look at it. Okay, so I'll just share my process here before I start giving you examples, right? So the first one is I have a minimum 18% annualized return is what I want from each special situation. So what this does is it forces me to participate only in those situations where my expected return is on the higher side. So what it does is, so even where I end up making a mistake, it kind of, if I have 10 special situations and I make a mistake in two or three of them, then on the whole, the blended rate is also on the higher side because I've gone into 18% plus kind of situations, right? So that is the number one. And number two is 18% acts like your opportunity cost. You don't want to go below this because your long-term portfolio would probably give you much more than this, right? So 18% is
Because
a
can I come in here?
yes, please.
Just for the sake of everyone's understanding, 18% annualized return in special situation is something which we should understand that sometimes special situation run for only a couple of months. And if in those 2 months you are guaranteed a 3% return, that turns out to be 18% annualized return, right? So that is how you should look at it. Not just 18% on the whole event, but annualized on an annualized basis. I thought that it is important to just
Yes.
explain it.
Thank you, Ankit. So,
Yeah, Vikas, please go ahead.
so this 18%, and Ankit mentioned, so 18% is on an annualized basis. So, which means if the situation is for 1 month, I want at least 1.5% return on it. And if it is 2 months, I want 3%. And if it's 6 months, I want 9% minimum. And if it's a year, then it should be minimum 18% annualized return. So the other thing is, I mean, Ankit and I, we've had a debate on this. So Ankit has said that, look, I'm getting better returns in my long-term portfolio. Why should I invest in special situations, for example, right? So my sort of counterpoint is that, look, I want to keep the two separate. So here my opportunity cost is 18%. So if I'm getting more than 18%, I'm okay with that, right? It is anyway short term. The money will earn some returns and it will come back to me in a short term, which I can then deploy it in the next situation and so on. So one other thing is I invest in special situations which are already in play, right? So for example, I will not invest in say ITC with the hope that they will do the demerger of the cigarette and the non-cigarette business and so on, right? That is pretty far-fetched. I don't participate in that thinking that that will happen, right? On the other hand, I would want to participate if that announcement has already been made, right? Then I will participate in it, you know. So I avoid speculative investments also. So whether they will demerge, don't demerge, I cannot keep waiting for that. That announcement should have been made for me to participate. See, third point is very simple, very important. See, as such, right? If you see my presentations and or if you attended the other things also, I like to keep things very simple, simply because I don't understand very complicated things. Okay, it has to be simplified in a way that I can understand, and in a way that I should be able to explain it to someone else, right? So I like only simple special situations. For example, there was this special situation in Mothers and Sumi, right? About how they were going to do the demerger of their business and so on. I looked at it; it was too confusing for me, so I decided to give it a pass, right? So these are things that you have to evolve your own style, but I'm just sharing what the way I do it. Okay, and for me, see, I want to protect my downside. Therefore, I want to limit it to only a few special situations, simple situations, and I don't have. See, I'm a one-person team, so I don't have too much time to spend on this. So it has to be simple. It has to be pretty straightforward, and the situation is already in play, and something where I can visualize a 18% annualized return. That is a summary of how I go about it. And as you will see in the next few slides, all the examples are about simple special situations. I'll just pause here before I start doing these themes, explaining. Does anybody have any questions or comments?
Anyone has any question? You can ask now if you want. Any doubt or any question? Because we can continue.
Okay, sure. So the first one is arbitrage, right? Okay. So I love arbitrage because of the way it sounds. Okay. So it just sounds something like so exotic and so on, right? So I love arbitrage. Okay. If you watched Seinfeld, there is this one particular episode called the bottle deposit, right? So there are these two guys, Kramer and Newman, right? They find out that in New York State, you get 5 cents a bottle. Uh, if you put your bottle or your can for recycling, you get 5 cents. But whereas if you put it for recycling in Michigan, you get 10 cents a bottle, right? So they realize, oh, there's a great opportunity here that we will take bottles and cans from New York and go sell them in Michigan, and we will make a profit out of it. So that is an explanation of arbitrage, right? You take something from one place and go sell it in another place where you can get a much higher price. Okay, and this is an example of a risk-free arbitrage. Okay, so in the 1950s, right? Uh, there was this company called Rockwood and Co. Um, so what happened was this company was in a chocolate products um, company, and its inventory. So the price of cocoa beans went up from 5 cents a pound to 60 cents a pound. Okay, overnight. So and they used the LIFO method, that is last in first out. So basically, in other words, what it means is uh, so the value of their inventory went up 12 times, right? And they realized if we sell the cocoa beans to make profit on that inventory, we will attract a 50% tax. Okay. So instead, what they did was, he said, why don't we give away cocoa beans as dividends to our shareholders, right? And then the shareholders can sell them and make a profit. So this company was giving away $36 worth of cocoa beans as dividends per share, and the price of each share was only $34, right? So somebody like Warren Buffett, he chanced upon this and he pounced on it. So he would buy shares at 34, take the cocoa beans and sell them at 36. And he made a profit of, and I think he sold it around $100 a share, right? Roughly. So he probably made a profit of $102 per share, right? So these are arbitrage opportunities which come only once in a while. But if you have turned on your inner that mental model to look for it, you will find what such opportunities. Okay, a similar example happened last year. There is this company called Majesco, and it was in the business of selling insurance software. Okay, and it sold its insurance software business to an American company sometime around July, August last year, right? And this company said that we will distribute. So even in the October 2020 conference call, they said that they actually came out with a very detailed presentation. They said with all the cash that we get, we are going to first do a buyback, and then we are going to do a special dividend. But all the cash would be returned to the shareholders, right? And if you did the simple calculation, you would know that close to about 1,000 odd rupees per of cash they had, right? And the price of that share was just 870 rupees, right? And so I've just listed down the dates here. So in October 2020, price per share was 870. So in July 2020, the price was even lower. Even after they announced the sale, the price was even lower than this. Okay. I have given October 2020 as a reference date because that was the date in which I actually came across this particular situation. And by December 2020, around Christmas time, they paid a dividend of 974 rupees per share. Okay. And assuming you kept it for another 3 months, you could sell the remaining share at 70 rupees. And today, the price of that share is 150 rupees. Okay. So now you bought it at 870, you got a dividend of 974, and you could either sell it in March 2021 or assuming you sold it today, you will get 150 rupees, right? So that's a net profit of 174 rupees per share. And on an annualized return, you will get somewhere close to 48%, right? So this is very similar to what Warren Buffett did, which is the arbitrage opportunity. Any questions, thoughts?
Because we'll take the
Yeah.
Anyone has any question?
Yeah, Avdut, this side, just cautionary statement. I would like to caution on this. We have to, I think, because we have to look at management also in this case, whether we will get that dividend or not. Yesterday itself, we have come across one such situation. I will not name it, but we have got, people have got paltry dividend of 150 rupees.
Sure.
So we have to take into account whenever one business is sold, we have to take into account the management behind it. Madhu Kela has a very famous statement: पैसा कितना आएगा उससे पहले सोचना है पैसा आएगा कि नहीं आएगा.
Sure. So, thanks, Avdut. I will address this in my. There's one slide on learnings and mistakes and so on.
Yeah,
I will address this. Yeah. So this is not a and that is what I have mentioned here. You can see it right here. So the risks in such deals are, one, the deal that you're depending on does not go through. So which means that there will be a downward price correction. Okay. And the second is promoters get greedy and then they don't share the proceeds, right? So Avadut, I will name the company. So
I was about to say that only. You can name the company.
Yeah. So there is this company called Hinduja Global, and that company is sitting on cash of close to 3,500 to 4,000 rupees per share, somewhere in between that. Okay, per share, and the price of the share is 2,800. And yesterday the price went down 20% because the management did something like number two. So they announced a very small dividend for the shareholders, but in the end they announced that a lot of money could go to in the form of intercompany deposits.
I remember we discussed this thing a couple of months back or 3 months back, Vikas. We were discussing on this.
Yes. About 3 months
So the
back.
only reason I couldn't think of investing in this was that looking at the past track record of the promoter, would you get the confidence that they will share the proceeds?
Sure.
Same thing with me, Ankit bhai. Same thing. I
Exactly.
didn't invest.
Yeah.
Right. So Vikas, before you move ahead, I think Saket has some questions. So Saket, you can go ahead. Saket, I think you are muted. Saket, can you hear me?
Yes. I think now it should be.
Yeah.
So, hi Vikas, how are you? Thank you for this presentation, by the way.
Thank you, Saket.
So my query is ki, see, in arbitrage, the opportunities also come, and also the risk is always there. And same goes in long-term investing also. So basically, the opportunities are there and risk is there. And same goes for startup also. So in every investment, definitely, there is some kind of opportunity and there is some kind of risk. What experience enables us is to understand the risk and mitigate them better in the ways that we do. So with your experience, I would request you to share some more thoughts on how you manage the risk, basically how you assess the risk. Rather, so every arbitrage opportunity or buyback or can anything happen that disturb the apple cart. But the experience enables us to identify कि हाँ यहाँ पे फंस सकता है, यहाँ पर इशू आ सकता है, जैसे कि GS में past promoter record का हो सकता है. So could you address some more जहाँ पर how do you assess this risk part?
Sure. So a lot of great questions, Saket. And seeing that noted investors like you have joined the call, it's only making me more nervous, Saket. So, but yeah. So
Vikas, I'm sorry I'm interrupting. So noted investors like you and Saket have recently joined Mission Smile family. So that itself makes us feel a little proud that we are in the right hands.
okay.
I must say, to be honest, we are all learning here and we are learning from each other experience. That is the only intention to be here.
Definitely, Saket. I completely agree with you. And we have many Mission Smile members. I don't want to take one or two names, but there are many people from whom we have learned, as in SmartSync Services have learned from discussions with them. So it's not about one or two individuals. That is for sure.
Okay, thank you. So Saket, it's coming down the line, but the one thing I can share is, for example, that what some of the mistakes I did early on was like too much concentration in one or two special situations, right? I would rather now I would rather have an upper limit on how much I want to invest in each special situation, and so I would take that risk by diversifying, right? Then the second thing is like how you would do enough checks on promoters, right? So, for example, pledging related party then then in the past have they been sort of fair? Have they shown fairness towards minority shareholders? So these kind of checks you will find it's I mean these are the sort of simple checks that I do looking at the promoter thing. And most of it people would have already found and discussed on platforms like Value Picker and so on, right? So I take sort of confidence based on that the track record of the promoters and have they been fair to minority shareholders. And the third thing that I do is I sort of diversify away that risk. This is what I do.
Yeah, because if you allow me, I would also like to share one thought.
Please,
over here.
Rakit. Please.
So, Saket, another thing which we can do over here is that you limit yourself, as in you take care of the risk by limiting the amount you are going to invest in that special situation thing. So even though there are positives and there are return possibilities, but you know that there is a risk as well. So you have to, as an investor, you have to think about how much you can invest in special situation plays compared to what you are investing in the long term plays. So that is also one way. So basically, बात वही है कि घूम फिर के कि you can't avoid these risks. You can only diverse. One way is diversification, which Vikas has already said. The other thing is the knowing about the history and all about the promoters and other things. And one very important point which Vikas mentioned in the earlier slides is that you don't get into the hope wala situation. You get into a special situation only when it has been announced, right? So that also makes probability in your favor, and odds are there in your favor. So these 3-4 things, I guess, pretty much. If you have any other suggestion or thought, anyone else, you can also share right now before we move ahead.
I think yes, that's good points. So let's move ahead and slowly and gradually we'll ping more questions then.
Very good question, Saket, but that's a very good question. Yeah, Vikas, please go ahead.
Yeah. Next was buybacks, right? Uh, so uh, so businesses have so 2 or 3 ways of returning money to shareholders, right? So one is buybacks, the other is dividends. Um, so uh, last year, when I say last year, I mean 2020. Wipro announced that they were going to do a buyback at rupees 400 per share. And this came when the price of the share was just rupees 340. Okay. And so we did some basic calculation of what would be the minimum that can get accepted, and that came out to be like 26%, right? And I'll tell you how we did that calculation. And the minimum return that we thought minimum was about 17%, right? Both of these are theoretical, or you can say sort of guesswork. So how do you do the acceptance ratio? So and see, in a buyback, there are two ways in which companies do buybacks. So one is called the tender process, and the other is the open market process. Okay. In the tender process, what they do is the way it works is you tender your shares. Let's say I have 100 shares, I tender all 100 of them, and the company would buy back a proportion of that. Say it would buy back 15% or 20% of the shares I tender, and the rest would be returned back to me. Right? Those 15% shares would be bought back at 400 rupees, and the rest I would get it back. So in tender process, there are again two categories. So one is the retail category, and the other is the institutional category. So anybody who holds shares worth less than 2 lakhs as of the record date, he or she would be categorized as the retail shareholder. Okay. So think about it this way: you will know whether you are a retail shareholder or not after the record date only, right? But you have to decide whether to participate or not much before the record date. So it's a sort of a conundrum that you will have, where you have to sort of come up with a theoretical or your guesswork of what the acceptance ratio will be.
Because if you have that Excel sheet with
Yes,
you,
I have it.
think you can probably share that. I think then all of us will be able to understand it even better.
Sure.
Yeah.
And can you see my screen? It's the
Yes,
Excel
yes,
sheet.
yes,
Okay.
yes.
Okay. So this so Wipro had 571 crore shares. Okay. And they were going to buy back 23.75 crore shares, right? At a price of 400 rupees. And they were going to spend 9,500 crores in the buyback. Now, as a retail shareholder, or rather, 15% of this 9,500 crores was going to be allocated for retail shareholders, right? And so if you do 1425 divided by 400, so that comes to about 3.5 crore shares that will be bought from retail shareholders, right? Now, the next one is little tricky. You don't know how many people will come under the retail shareholder category, right? So to arrive at this, um, what we did was, so you have 2 lakh rupees is the retail. Anybody with an investment 2 lakh rupees or below is categorized as a retail shareholder. So 2 lakh divided by 400, okay, it comes up to 500. Am I right? 500, right? 500 shares. So you want to know how many shareholders are there in the category who hold anywhere between 1 to 500 shares, right? And that you will have to say go to the annual report and look at the shareholder distribution, right? So that is one way in which you can find out. And so we estimated that somewhere between 13.56 crore people could be there in the retail shareholder. And if all these people tendered their shares, we would arrive at um, an acceptance ratio, the worst case, somewhere around 26.27%. Okay. And so then we went ahead and shares.
Because we lost you in between.
Okay. So what thing you heard?
We could hear till 26.27%, the acceptance ratio.
Yep. So so we got a theoretical acceptance ratio. The worst case was somewhere around 26.27%. So based on that, we came up with a few scenarios where we said that, as you can see, if the acceptance ratio is 26%, what would be our return? If it's 30%, what would be our return? So at the bottom, you can see, for example, if it was 26%, we would get about 4% in 3 months. If okay, which annualizes to about 17%, right? And if it is 5%, we will get about an annualized return of 20%, and so on, right? And if 60% of the shares have been get accepted, we will get a return on investment of 10% in 3 months, which annualizes to 40.88%. Okay, so you can see that, remember I told you our investment threshold was 18%, right? I want anything above 18% should be my annualized return. And on the other hand, here I have a range of outcomes which are possible. So since the upside seemed to be much bigger and much higher than the downside here, we decided to participate in this. Okay, so it is in a way, it's a what do you say, a probabilistic kind of thinking, and we went ahead where we thought the odds were in our favor. Okay, so now here is what happened. So so this was around October when we bought it at 340. Then by the time December, January came, the price of the share itself had gone above 400, right? So which means that I can now sell all 100% of my shares at the market price, and I can make a profit there. And that's what we did. So sometime in Jan, we sold all our shares, and then we made about 67 rupees per share. We just sold it in the market. We did not tender it in the buyback. In fact, the only people who tendered it in the buyback were the promoters, right? Because they have a large shareholding and so on. So the Premji family was the only one which tendered their shares in the buyback, okay, at 400 rupees. Whereas everybody else would have probably sold it at the market rate, which was much higher. And when you calculate your IRR, it came to about 114%.
I just wanted to make one point here. So Vikas has actually explained. If you can just share the Excel sheet again, Vikas.
Sure.
So we must understand here that this is the possible number of shares among retail shareholding. So even if you take the number which is available on the annual report at the date on which you are buying the shares, the actual number of shares could be different, and it keeps on changing till the time the buyback record date is there. So you should always give yourself that room for error, because this is not the actual number, right? And this number can change. So that is what I wanted to.
Can I ask one question? Avdut this side.
Yes, Avdut, please ask.
About this number, there are two ways to look at it, right? One is one you mentioned that it is mentioned in the annual report distribution, which will,
Sure.
and second is in the if suppose the buyback has come in part of the December or something. Let's take example of TCS, which has announced they will be declaring buyback on 12th January. So if we go for the annual report must have come out somewhere in the September, right?
Right.
August or September. So it will be much dated data. In that case, can we have a like shareholding pattern would have come out, right? By 31st of December or 1st of January, we would have TCS shareholding pattern, recent shareholding pattern, where it will be mentioned individuals having shares less than 2 lakh or something. It will be mentioned in the shareholding pattern, right?
So, so the problem there is what is mentioned on, let's say, the BSE website, that is share capital, right? So if the face value of the share is 10 rupees, so it means that all shareholders who have up to 20,000 shares, that's what it means, right? But it does not account for the market value of those shares.
Correct. Okay.
So that is the problem that you have.
Okay. Then our best source would be annual report only in that case.
And see, all these are guesswork. See, we did one more. Yeah, we did one more buyback in SIS. Okay. There, when we went with the numbers in the annual report, the acceptance ratio was pretty high, right? But when the actual shares got purchased and all that, that acceptance ratio is much lower than what was the theoretical thing, right? Because by that time, a lot of retail shareholders had come into the company. So, so we went with the data, but it was of no use.
Exactly. So one thing which I wanted to add here, Vikas, is that probably the better one good thing to do is, as a practice, is if you just scroll down your Excel sheet. Yeah, over here. So scenario one, Vikas has written 26%, right? Acceptance. So just to be a little on the conservative side, you can also have a scenario zero of say about 15% or 20% acceptance, because as he mentioned in case of SIS, what we thought was in fact even that was much lesser acceptance. That was a higher expectation acceptance ratio. So the actual acceptance ratio turned out to be lower than what we calculated. So that could probably, Vikas, be. What is your thought on that?
Yeah, that's you could do that. So, so Ankit and Avdut, see, here is the thing, right? So, Excel is a great tool, right? And but it cannot be substituted for our thinking here. So it's a good thinking aid, but it is not a good master which tells us what to do. You can play around with all scenarios and all that, but ultimately it will come down to, okay, are you comfortable with that risk reward ratio that is there? It is probabilistic here, so you have to take a call. In the case of Wipro, it worked out. In the case of SIS, it also worked out, but the acceptance ratio was lower.
Okay, thank you.
That's why having that threshold of I will not participate until I have 18% annualized return, that's where it sort of protects you, because one might give you say 20-30% IRR, another one will give you 12% IRR. So on a blended rate, you will still make about, let's say, 20% in a year.
Yes, Vikas.
So this was Wipro. Yeah, and as I explained, 15% of the buyback amount is reserved for retail shareholders. But who is a retail shareholder, you will get to know only after the record date has passed. But your decision to buy or not is before the record date. So there are some big drawbacks in buybacks. And so this one, I have decided not to participate in any more buybacks. Because one, the retail quota is too small. You can deploy only say 2 lakh rupees, and that too you are not. It is a very very theoretical calculation whatever we are doing. So I have decided not to participate anymore in buybacks. Instead, I will focus on open offers, right? And the other thing is whatever shares are left behind, right? So now you have a choice: either you hold it or you have to sell it at a lower price, right? And I think Professor Bakshi mentioned it somewhere. So wherever special situations don't work out, then you better start reading the annual reports, because now you're a long-term investor in that company. So, so if this, so this is a risk that you are carrying in buybacks, right?
Yeah.
So it is a
I think because we should mention this point also. So when you realize that the buyback has not worked in your favor, it is better to sell it immediately when the event is over, because
yes
you have played only for that event.
buyback.
Yeah.
Yeah.
And it's better to leave it there. Even if you want to study that business for a long-term perspective, first sell the shares, because that will help you be unbiased and then look at it with a fresh pair of eyes. Otherwise, you will always be having that kind of a social, that psychological baggage wherein you don't want to get out because it's in loss, right?
Great,
Ankit,
great point.
Ankit bhai, one contrary point. If you remember to Richer, Wiser and Happier book, in the first part of it, Monish Pabrai asked Charlie Munger how he looks at the 3 points Charlie Munger has given him, that you look for the buybacks and great investors, and third point I don't remember. If you look at this and you start digging out about those companies, so buyback could be one point where we can start about digging about the company and investing into it for the long term. I missed it. TCS first buyback, which came around 2,400. I missed at that point, and acceptance ratio and stuff. But I missed the whole picture. The company is good going forward. It is going to do good. If the company has tailwinds and plus it is coming out with the buybacks, then we should definitely look at it for the longer term perspective. That's my perspective.
So Avdut, you have to also bear in mind that why buybacks, right? So buybacks, in a buyback, you as a shareholder, you will incur only short-term capital gains or long-term capital gains, right? Which could be 15% for short-term and 10% for
Yeah.
long-term,
Yeah.
right? But so irrespective of how big a shareholder you are, okay. But if you get dividends, for example, I have heard it can go as high as 43%, right? So so it's in the interest of promoters to do buybacks than to do dividends. Okay. So just bear that in mind as to why so many companies in India do buybacks.
Understood. Taken. Point taken. Thank you.
And just to add one thing over here, Avdut. So a promoter, or say for example, a company like TCS or Infosys or Wipro doing a buyback is more of a capital allocation decision.
Cash.
But when yes, and when what you are talking about is when a company's share price goes really down and it becomes really really attractive, and at that point of time, promoter wants to signal to the market that I am buying back the share. So that these are two different things. So over here, in case of IT companies, they are not trying to signal that these are as in bargain stocks and go and buy it. They are doing a special capital allocation decision, right?
Correct.
I hope you can understand the difference.
Yeah.
These two.
IT companies, I agree with you. They have huge cash and they have to deploy it. So it is
Right.
capital allocation. I agree. Thank you.
Yeah, please go ahead, Vikas.
And sorry to keep on interrupting in between.
No, that's great, Avadut. Please ask questions. Okay. So next is demergers. So demerger is when one company spins off a division of its company into another company, right? Or that spin-off could then be sold separately, right? So usually it takes about 1 year from the date of announcement, as it requires several approvals. You need to get so first the board approves it, then the shareholders have to approve it, the stock exchanges have to approve it, the creditors, NCLT. It's a long drawn process. Okay. So from the time of the demerger announcement, roughly, I'll budget 1 year in your mind, right? So one company which one of my friends brought to our attention was GHCL, right? So this is a company with two separate divisions, chemicals and textiles. So before I go into GHCL, right, one other thing to bear in mind is in demergers, right, when you have two divisions, especially when they are like not related to each other, like chemicals and textile. So it is like a three-legged race, right? So where two people tie, so for example, if Ankit and I were to do a three-legged race, so my right leg and Ankit's left leg would be tied together, and then we have to run. So now, when we run, we will be slower than what each of us could individually have run, right? And that's how the market also sees a conglomerate kind of a business, right? But when both of us, when that are untied, and now both of us will get a valuation, and that will be greater than what it was earlier. So in other words, the sum of the two parts after demerger will be greater than the whole which was before the demerger. That is usually the logic here. And they think, okay, a textile company can now operate independently like a textile company. It can do whatever capital allocation decisions it needs to do. And same for the chemical division, right? One is not constrained by the other. So this company came into our attention in December 2020. And you could see that, for example, the chemicals business, even though both are commodity-like, chemicals and textiles are commodity-like, the chemical business was actually, had significant moats in that business, right? And it had a consistent EBITDA of somewhere in the 25 to 30% kind of a thing, okay, irrespective of the market cycle. Whereas the textiles in 2000, as of March 2020, it had an EBITDA of only say 7%, and both were commodity in nature, right? And they were going to demerge this, right? So we did some basic, I would say, really basic calculation, and it came out to something like an EV EBITDA of. So we did say so. FY20 numbers are there in the first column. And for chemicals, we assumed an EV EBITDA of 5 times, and for textiles, we assumed it to be 1 time. And this was the debt scenario at that time. And as you can see, the market cap um of the chemicals alone was significantly higher than the combined together, right? So which gave us a margin of safety of something like 38%, right?
Just to add on Vikas here, so just look at the EV by EBITDA assumption which Vikas has taken here. So 5 times EV by EBITDA and 1 times EV by EBITDA for chemicals and textile. So this is extremely conservative assumption. So that is how you are building in your margin of safety, right?
Yeah. Thanks, Ankit. So the other thing was when you compared GHCL as a chemical company vis-a-vis something like Tata Chemicals or Bodel Chemicals, right? Other commodity. So you could see that GHCL was far better in terms of the EBITDA margin and so on. Yet it was trading at a much lesser EV EBITDA. Okay. So you could see that there is some upside that you have in this situation, right? And that is what we did. So we bought it at around 190, 200, somewhere in December 2020. And by 21, it was now at 360. Sometime in October, it had even touched 460, I think, right? So, but it has given a decent return. And so when you calculate the IRR, it's come to about 61%. Now, there has been a kahani mein twist since then, right? So last month they announced that they are selling one part of the textile business to Indocount for about 596 crores, right? And that cash will be used for both reducing debt and growth capex. And remember, I told you demerger takes about 1 year. So we were almost going to get the NCLT approval when they sold one part of the textile business, right? So now what they're doing is they are saying that a fresh petition will now be filed uh, to demerge the spinning business from the chemicals business. And the spinning business, it'll have close to 2 lakh spindles, and if you assume 50,000 rupees per spindle replacement capacity and so on. So this is something new that I learned. So he said, we will get about 1,100 crores as the replacement value for the spinning division, right? And meanwhile, what has happened is the soda ash prices have also gone through the roof, right? And so sometime in quarter 4, I think they will start uh, writing new contracts with the new prices, soda ash prices. So the chemicals business is also likely to see a further uptick in profits, right? So even as of today, I would say that we are still invested in this, and even from this current market cap of 3,600 crores, I think there is still some upside to this story, right? So another 6 to 9 months, that spinning division could get demerged. Another example of demerger is this company called IDFC Limited. So I think everybody would have heard of IDFC Limited. So it's the holding company, and it's a complicated structure that they have, right? But essentially, they have two big units. One is a mutual fund company, IDFC AMC, and the other is the bank, okay, which is the IDFC First Bank. So holding companies or the parent company usually trade at a significant discount to their underlying value, right? So the market says that, look, if I want to buy IDFC First Bank, I will buy shares of IDFC First Bank. But if I buy shares of IDFC Limited, it becomes a little complicated because IDFC First Bank's profits will now be uh, apportioned to IDFC Limited, and from IDFC Limited, there is another capital allocation decision that will have to be made, and so on and so on. So holding companies usually are more complicated, and the market, assigns a big discount to their value, right? And this is no exception. So so as of now, also, so the market cap is of IDFC is 10,000 crores, whereas AMC and the bank put together will be about 15,000 crores. So this is also another form of arbitrage only, right? So we are buying the parent company as a way of buying the children companies, right? And so why is it different this time? What could happen, and what are the triggers? See, first of all, in the last, so we've been invested for nearly 2 years now in this company, and a lot of action has happened in the last 3 months alone. Okay, so the first and foremost was there is shareholder activism now. So the company had a call with all investors just before the AGM, sometime in September, right? And you would not believe the kind of the how senior investors joined the call, and they blasted the management for not doing this value unlocking fast enough, right? Uh, so you had very senior investors like Madhu Kela, uh, Mr. Rajiv Agarwal of Doordarshan Investors. These are some of the names that come to mind, but I recall that it was a pretty heated call, and they blasted the management for not doing enough. And pretty soon after that, you now have a new chairman of the company, and the new chairman is Mr. Anil Singhvi. He was the CFO and the CEO of I forget which cement company, right? So he has been brought in. He has a reputation of being clean and getting things done, right? So he's the new chairman. They have announced that they have appointed investment bankers for selling the AMC. The boards of IDFC and IDFC First Bank have both approved for a reverse merger, and there is also, as we speak, there is a postal ballot for simplifying the corporate structure of IDFC Limited. So you could see that
Which is
a lot of
cement you are talking about, right?
yeah, the cement company. I forget which one, Ultratech or
No,
no,
Digvijay
Ambuja,
Cement.
Ambuja,
He was earlier with Gujarat Ambuja and then
Gujarat.
Digvijay.
Hmm. So, so these are some of the events which have happened in the last about 3 months, and so that's why I'm kind of hopeful that this time the value unlocking will happen, let's say within the next 1 year. And so this has been our investment in this company so far. Okay, so this was about demergers. Uh, so the risk is that we expect the sum of the parts to be greater than the whole, but the opposite may play out. So I remember in one of the earlier deals, we bought Thomas Cook because we were getting shares of Quest, right? And we thought post demerger, the sum of the parts will be greater than the whole. But for a few days, it was the opposite, right? I could have bought Quest separately, I could have bought Thomas Cook separately, and I could have still saved some money, right? For a few days, it was like that. And so that's when one of the learnings was to, if you want to play demergers, you want to get in on the story early, and you want to wait it out for a year or something, rather than going into it at the late stage. Avdut, any questions? Anybody, any questions?
Yeah, Vikas, Avdut again. Two questions. First, see, two ways to play a demerger, right? First, you mentioned about some of the parts and buy it in the beginning. The other way around could be you after demerger, you will know which one is going to be a smaller part. Just for an example, uh, let's take a Mothers and Sumi. You explained first. You mentioned that Mothers and Sumi. So Samil will be the bigger part going to be, and domestic wiring harness will be the smaller part. It is going to be. So Mothers and Sumi, FII DII holding is huge. So they will sell the smaller part most probably, and that will become a value pick, and we can buy that. That's one part of playing it, right? And
Yes.
another is what you mentioned is, so how do you decide between these two, which one I'm going to play, either this one or the other one? Or have you played the other part, like buying it?
So I have correct. Great question, Avdut. So I have played only the getting in early and sticking through the demerger. Yesterday, day before, when I was reading or rereading the Joel Greenblatt's book, that's when that idea, what you are saying, jumped at me. It said that you want to buy the one
Correct.
which may not be preferred by the market, but which has good fundamentals.
Correct. So
Yeah.
I have played on that idea, and I'm not good at what you mentioned, but I would definitely like to learn it from you.
Sure. Thanks, Avdut. I will have to think about what Joel Greenblatt is saying and look at it that way.
Yeah.
It is a new way of looking at it. But like I said, so like the Ekalavya approach, right? So you learn something from these masters, and I tried something, and then now I want to go back and reread it because new ideas might come from that same thing. So
Absolutely. Thank you.
Hello everyone, Dhruv here.
So,
I have a
so
question. If it's okay, I just wanted
Yeah.
to know how do you
yes, bro.
time purchase in case of demergers? Since the process is quite long, one and a half year probably, and you have to get approval from creditors, NCLT, and all such things. So when do you think that okay, this approval has gotten approved, so value unlocking abhi ho sakti hai? I just have the dilemma always, so I wanted to know your views.
Yes. So yes, Avroh, yes, Dhruv. So we just like at least in the case of GHCL, for example, every quarter the earnings presentation they were giving a sort of a breakup of where they are in that milestone process. So it was sort of a visual you were getting a feel of progress, right? Shareholder approval हो गया, अभी creditors का approval हो गया, we are waiting for this process. So you would get that sort of a visual feedback every quarter. And so that gave us some confidence that this will happen. This is likely to happen. Right?
Like
And corporate file.
Yeah, I was
Go
just
ahead,
saying
Dhruv.
that recently all cargo logistics have also announced that demerger will happen. But the time frame for the demerger is one and a half year, easily.
Hmm.
So how do you
Yes.
time that purchase? I just had a confusion since I was researching about that. So your opinion will help.
How do you sorry?
All Cargo Limited announced a demerger. So in that demerger's presentation, they said that it will probably take 1.5 years to 2 years to get all the approvals and for the listing process to take place. Like they're mentioning that it will happen
Yes.
sometime in 2023.
Okay.
So how do you time your purchase? Yeah, do you see that now there is ample margin of safety, and based on that you calculate
Yes.
implied
Yes.
return?
That is exactly how you would do it, Dhruv. So, or at least that's how it worked out for us in GHCL. That we looked at the two parts of the business which were getting demerged, and we felt that even after assigning a conservative multiple to those two parts, we were getting a good value unlocking there. So that's why we bought it and we decided to wait for it.
Got it. Okay, thanks.
Just one thing to add here, Dhruv. Very good question and good answer by Vikas. But so there are two process to it. So two steps to it. First, you should be very clear that you are getting some sort of a margin of safety in terms of the valuation. So like in case of GHCL or in case of IDFC Limited, what Vikas said that he had that ample margin of safety where he could buy that even 1 year or 1.5 years before the whole this thing demerger taking place, actual demerger taking place, right? So valuation is the starting point, and then the second step comes where you are getting that confidence, where you are seeing that okay, the company is making the regular, जैसे एक active shareholder की meet हुई, which Vikas was talking about the IDFC. So these things give you some confidence that no, now company will have to make some efforts there, right?
Yeah.
Because one more question. GHCL or all cargo, what Dhruv mentioned, all these things while considering buying before demerger, do you take into account tailwinds? Because GHCL being a commodity business, tailwinds or the headwinds for the business, and take that into account while
Yes,
valuation.
Abdul. Yes, Abdul. So the longer that you have to stay invested in the business, there are more things that can
Go wrong.
that you would have want to consider,
Hmm.
right? So GHCL, for example, had a little bit of a shady promoter background, right? But then again, we were like investing a small part of our special situation portfolio into GHCL, and we were buying it when it was relatively cheap. So that gave us that sort of margin of safety there.
So what would be positions? How do you size the position for each of these opportunity and of the total special situation funds?
So I don't have a great answer to it, Avdut, because so the way I do it is I have a separate P&L for special situations, which is different from my long term, right? Now within this amount of money, let's say I have 100 rupees to invest in special situations. Um, so I have been trying a few different things like open offers and other things where I've actually deployed very small sums of money because even I wanted to sort of learn the process before I invested bigger sums of money. Um, so there I've deployed say less than 10% per open offer. But something like a GHCL, which I'm starting to like with each quarter more and more. So there I've deployed something closer to say 20% of that special situation bucket, right? And where I can see that the demerger is going to sort of yield, it gives me a confidence based on what is my expected rate that I can get, expected return, and the quality of the company and where it is going. So wherever I have that combination, I would deploy more.
Okay. So you will not invest full amount initially, but as soon you get confidence, you will keep on building your position.
Yes.
Understood. Thank you.
Because if you would like to share, say if you have 100 rupees, how much you are invested in special situation and how much in your long-term holding?
I think it would be say somewhere around 15 rupees for 15% in special situations and 85 in long term.
Any thought behind this, or it was just
No, just a thing, Ankit. I thought 1585 or somewhere around. It would be somewhere between 1090 to 2080, somewhere in that thing.
And Girish in the chat section has asked about GMR demerger. Have you looked at it? Because
Yeah, I looked at it. It just looked little complicated to me. Like I said, right, I like to go for only simple ones. When I looked at the GMR demerger, so friends, for everybody's benefit, so GMR is an infrastructure company. So they have road assets and they have airports. So they own airports in Delhi, Hyderabad, Goa, I think, and some few international airports. One in Philippines and one in Greece, I think. So airports are a great business to own. But what is sort of making it a little harder for me is that so this airport business, I think 50 odd percent or something is now owned by some other company, a French company, right? So GMR itself owns only 50 odd percent of the airports business, and so they want to demerge the two companies, and and so I was like, I want to see the airports business, how they're doing. Even they have a lot of debt on their books, and how are they going to manage those things before I invest in the airports? So this one I will play it like the way Avdut was mentioning. I will buy the one which I want to own, not the. I will not buy the whole and then sell the two parts separately. But I would rather wait for the demerger to complete and then then try to buy the airport business.
Vikas, Dhruv here.
yeah, because it's 12:20, we can go ahead with, yeah. Anybody has any question?
Dhruv was talking.
No,
Dhruv.
I think we can talk at the end. I think it's okay. It was some other examples also. I think in the interest of time, we can take it at the end.
Okay, sure. Uh, open offers. Okay, so now so this was something that I came across by chance. This special situation called open offers. Uh, so I'll just deviate a little bit. Okay, so it was like you can think of it as a funny anecdote. So in 2018, right, December, we came across a small company. It was a small BPO company. It was the price per share was somewhere around 180, 190 rupees per share, right? And the market cap was about somewhere between 270 to 300 crores. And what was interesting was this company of 300 crores did not have any debt, and it had cash on its books of something close to 150 crores. Okay, and they had a product they were coming up with a product slash platform which was growing fast and which was like quite profitable also. And but the thing was, the management was saying in all the calls saying that we want to use the cash for acquisitions and so on, right? So at that point of time, right, I was so inspired by Carl Icahn and others, right? So friend of mine and I, we okay, I'm saying this, and I'm laughing at the same time. We wanted to do a hostile takeover. We said these guys are no good at running this business. We can buy this business and do a much better job at value unlocking, right? So then we read the SEBI takeover code, right? We were watching videos and taking notes on what is the SEBI takeover code and so on. And that is how I came across this thing called open offers, right? So this was December 2018, and we did not. So here's the thing: we tried for 1 month. We tried to contact some senior investors and say we wanted to discuss and you know, uh, please tell us if you are on the right track and all that. But obviously nobody gave us any. Nobody took us seriously. And we thought, okay, maybe we are also overshooting here. So we dropped that idea. Both of us owned one share each of the company. That's it. And this was December 2018. The price of the share was 180 rupees. April 2019, which was just 4 months after that, the company got acquired at 320 rupees per share, right? So we were in a way right about the value, but we did not act on it. And yeah, so but the thing is, out of that came the idea for open offers. So sorry for that deviation. Just coming back to open offers now. So open offers, so whenever one company wants to acquire shares of another company 25% or more, then company A has to make an open offer to acquire another 26% from the shareholders of B. Okay. So for example, Reliance acquired Just Dial, right? So Reliance paid somewhere close to 1022 rupees per share to the owners of Just Dial, promoters. And so then Reliance had to make an open offer to the shareholders of Just Dial and acquire minimum 26% from those shareholders at the same price, 1022. Okay, there's actually a formula for calculating the price. At a minimum, it will be 1022. It can be more than that also. So recent examples are Pharmacy acquired Thyrocare and then had to make an open offer to acquire shares of Thyrocare. All Cargo's acquisition of Gati, I think somewhere around Feb 2020. So open offers can also be voluntary. So so last year, so Lycus, there is this company called Lycus. Vijay Kedia was a big investor in Lycus, and uh, so the guy who was running the company himself owned 12%, and Vijay Kedia owned 35%, something like that. And but Vijay Kedia he said that he regretted buying this company and he wanted to exit. So the promoters started buying shares of Vijay Kedia, right? So, and not only that, this promoter also, instead of buying just 26% from the market, he made an open offer to acquire 35% from the market. Okay. So the promoter group had 47%, so the public had the remaining 53%. So 35 by 53 gives you a rough acceptance ratio of 65%. So, and the other thing was, amongst the 53%, there were some large shareholders, like the brother of the promoter and so on, right? So I assume that these guys are not going to, tender their shares since they were close to the promoter or whatever. And the open offer price was for rupees 20. So what we did was, in July 2020, we bought it at 18.3. And I think sometime in August 2020, before the tendering process could start, the price of the share had reached 20 rupees. So I said, why go through the tendering process and tender it at 20 when I'm already getting 20 before that. So we sold it in 2020 itself, August, and we made a good profit on that. Shall I go to the next one?
Yes, Vikas.
Okay. There was this another company called International Conveyors, and one promoter group wanted to increase its stake from 15% to 27%. So they came up with an open offer for rupees 33 per share. And so again, here the minimum acceptance ratio was pretty lower, just 24%. But I still went ahead with it. I thought, okay, let's see what happens. Let's try to learn from it. Okay. So by August 2020, we bought it at around 29.1, and December 2020, we tendered it in the open offer, and here the acceptance ratio was less than 100%, and but we made a net profit of close to 3.4 rupees per share, and which gave us an IRR of 46.9%. So if you remember when I was discussing buybacks, right, I thought open offers are much better than buybacks because A, I'm not constrained by that 2 lakh rupee wala limit, and B, it is much easier to sort of guess what would be the acceptance ratio. Because there is no retail quota, non-retail quota, all that stuff, right? So it's a little easier to guess what the acceptance ratio will be at a minimum. And again, you want to participate in the ones which have a good upside. That risk-reward ratio is in your favor. So the risk, one big risk that I can think of is the process may get delayed or it can get cancelled, which can lead to a downward price correction, and you will lose some money in there. Okay. So, for example, in international conveyors, the process was supposed to close in 2 months, but it took 4 months to close. But despite that, the IRR was pretty good. So what I'll do is I'll just wrap it up. I think there are about 1 or 2 more themes, and then I'll wrap it up. We'll have sufficient time for question and answers then. This is something I don't have a proper name for it. This is something that I just thought of: deep value plus triggers. So there was this company called Prabhat Dairy, and it sold its dairy business in January 2019 for about 1,700 crores. And just like what happened with Hinduja Global yesterday, there was a extreme reaction, negative reaction to that news. And as soon as the news came out, the price just fell to 48. It was somewhere around close to 100. It fell to 48. That was the negative reaction. And so post-tax, the company expected about 1,300 crores or 130 rupees of cash per share. And the company kept reassuring investors that we will distribute a majority of this cash right? And they came up with a delisting proposal in 2019, September 2019, and but they finally delisted sometime in 2020. Now, in the September quarter, when they came out with the results, the numbers didn't look. I mean, when I looked at the balance sheet numbers and the cash flow numbers, I remember I even took it to my CA and I said that, look, can you make out something of this? Why are they double counting some of the cash and the business which is held for sale? Assets held for sale was also shown and cash was also shown. So it was all a little confusing. And so then we decided to exit from September onwards. So this is a company with questionable corporate governance, but we found that out only later, right? But nonetheless, the initial, the low buying price gave us that comfort. So we ended up with a IRR of close to about 53% on that deal. The big risk, big lesson for me was, so even though we made money in that deal, I would say, you have to be very careful with these kind of situations, especially with questionable corporate governance and so on, right? They can ruin the party. There was a company called Lloyd Electric, which again, sold its one part of its business to Havels, and whatever cash came into the company, the promoters swindled some part of it, right? And then Porinju Elliott filed a SEBI complaint, and after that, one by one, all the board members and the CXO team, they started resigning one by one. And yeah, so a lot of things, it can ruin the party, questionable corporate governance. So you want to be very careful when you play this particular theme. Deep value plus triggers, right? See, even in the case of Hinduja Global, yesterday alone it fell 20%. But if it keeps falling at some point of time, I would be comfortable where knowing that it has so much cash on its books, it could possibly make sense to buy it, right? But then for that, the price has to fall a lot more to give me that comfort. Yeah, last one is special dividends. This again, I looked at Gaurav Sood's video and I was like looking for how to do this on special dividends. So, special dividend is where a company has already declared a dividend and record date. You buy it before the record date. You take the dividend and then you sell the company, sell the shares, right? So you would make a profit on the dividend. So that's what we did in Oracle Financial Services. It was a really small amount that I deployed here. This was more to learn rather than earn. And similar one, I tried to do it with Pfizer also, where we bought it around 5,000 and then sold it around 5,000, and we pocketed that dividend. And yeah, so one thing with special dividends is that you need to know the laws regarding dividend stripping. So earlier people would do what I just told, what I just mentioned, right? They would buy shares of the company, take the dividend, and sell the shares at a loss, right? And that loss, see, and this was at a time when dividends were tax free, and but the capital loss that they would have encountered on the share, that they will offset it against the gains in some other shares, right? So they were getting double the advantage, and government obviously does not like all that, so they have made a law that you have to buy shares before 3 months and you cannot sell it uh, up to 3 months after the record date. uh, Only if you do that, and you have capital losses, then you can claim that claim those capital losses, right? Otherwise you cannot claim the capital losses. And the second thing is the dividends have been taxed now. So this theme is no longer that attractive, and there are some risks also. For example, the share price might not bounce back uh, uh, to the same level at which you bought it. And so neither can you get capital loss from that investment, and you actually have a loss which and your dividends are taxed, and you also have a loss on your investment. So it's not so attractive anymore. And this, like buybacks, I am not participating in it anymore. So I have shown you some all the good side, the good picture of my track record. But there is another side of it which also I want to tell you. So I made quite a few mistakes too. So for example, in 2019-20, Tata Chemicals was demerging its salt business and putting it into Tata Consumer Products, right? So I got into it very late, and as a result of it, and immediately after the record date, the price just tanked because that was the COVID crash also happened, and I think I held on to it for about 2 months and then waited to sort of recover most of my money, and then we exited at about 6% loss there. Another one I mentioned was the Thomas Cook Quest. So Quest was a subsidiary of Thomas Cook, but they were separating the two business, Thomas Cook and Quest. And there again, I think we bought into it very late, and as a result, but lucky for us that Quest worked out, and we sold Thomas Cook, but we held on to Quest, and Quest worked out. So, but I think it was a mistake. The way I did it was a mistake, right? With the demergers, like I have been mentioning, you want to get into the deal early and wait it out rather than getting into it very late, right? Or you do what Avdut mentioned, that you wait for the deal to consummate and then you buy the the one which is cheaper but also more attractive. Okay. Yeah, number 4 on that list, which is that NIIT, right? Um, I I'm laughing as I say it because I did some really stupid things with that particular deal. I didn't even know how a buyback would happen. It was my first buyback. I bought shares of it, and I took the dividend. Then what I did was I transferred some shares to my wife's account because I thought at least one of us should participate in the retail category. And I did whole lot of silly, stupid things with that. So the learning is keep it really simple in a buyback. You want to buy it. If you want to participate in a buyback, buy it so that you can do it in the retail category. Hold on to all your shares, and then sell. Tender it in the buyback, and then after the shares come, then you want to sell it and exit. Right? Don't do these over complicated, over smart things like the way I did it in 2019. And yeah, even though I started with arbitrage and I did not participate for some reason in Majesco, and so I thought I should. There are a lot of things that you can learn by just participating. And since I was deploying only a small part of my special situation money, I think I should participate in it to experience it and to learn it. So my last slide. So special situations are like, it's like swimming, right? You can read all the books you want on swimming, but you will learn it only when you start doing it. And the time window to buy or sell is really small. So you have to be very clear if you are in or you're out. So, for example, Hinduja Global, I studied it. I chose not to participate it for very. I should have written down my reasons why I'm not participating, but I did not do that. I just decided to not participate, and then I saw the price go all the way to 3600, and I was kicking myself to have missed out on it. But yesterday the price crashed to 2800. But I would still say it was the decision should be very clear that either you're in or you're out. And no point not buying it but seeing the price every day. That also will not help. right? So you have to be very clear whether you're in or you're out. Okay. And another thing, that avoid complex special situations. That is, I have tried to follow it. You should be able to understand it. You should be able to draw it if required. That this is the business. This part of the business will go out. This is what it will fetch. It should be simple enough for you to understand. And so that is very important. Um, One thing that has worked for me is that I have a few friends, and they keep sharing such ideas from time to time. This I thought was much better than trying to find all the special situations yourself. Uh, Having a network is better, and maintaining a separate P&L, like I said, with an 18% threshold, that will also be good for you to track it separately. And just having some rules, like simple rules, like I will not invest more than 10% in a special situation, or a 15%. That kind of a thing will also protect you. I have done really stupid things, like I invested 20% of my money, overall thing, into something like Prabhat, right? Which I would, in hindsight, I would say was a stupid thing to do. I should have invested a far lesser amount, given that so many corporate governance issues can happen, right? But yeah, like I said, going back to point number one, it's like swimming. I can tell you all this, but until you experience a couple of them yourself, you will not be able to appreciate some of these things. Um, yeah, and I have, in my presentation, I've also given links to some of these things. So yeah, please, this is like uh, very important resources, right? Yeah, I'm done here. We can take more questions, if any.
Thank you so much, Vikas. That was really, really wonderful. On the resource part, I just wanted to add that there's also a website called Invest Karo India, and there this person has actually got made a crowdsourced uh, uh, website, as in
Tariq Hussain has done.
yes. So that is also a very good place to look for special situation ideas. What is currently active there is a very good place to probably look for new ideas. But as Vikas has mentioned, the best place anyways becomes the SEBI website and the BSE corporate events, right? So with this, Vikas, I think there was one question left by, I think Dhruv was supposed to ask one question. So we can start with that question. Dhruv, are you there?
Not a question, but just sharing. I have participated in the GMR trade.
Okay.
And the other thing, I think, for all of us, which we can look at a simple trade, which we can discuss and probably learn from, is the NMDC one, which will happen probably next year. It's a simple trade
Right.
where just the steel business is getting demerged, and it would be a good workshop for all of us to share our ideas and thoughts on that.
Right.
Uh, uh, Avdut this side, Vikas. Vikas, have you after open offers, have you looked at the companies about what happened to that companies going further? Do you keep in long-term view about those companies? So my mistake has been that, because if there was a demerger of uh, Max India, and Max Healthcare was taken out from it, and there was open offer, right? Sorry, not open offer, promoter change was there, and uh, that business turned out well going further. That was for the demerger point of view. And open offer point of view, HCG. I remember CVC took over HCG, and the investments or the capex program has already stopped. So that became a good point of view, and HCG could be health care global can be turned out going further well for the CVC from the CVC. So do you look at it after open offer or before applying for the open offer, long term point of view? Another point in case is Escorts open offer. Currently Kubota is going to take it over, and if you look at it at a longer point of view, Kubota can anyway do better job in the long term for 5 years. So do you look at it that way?
Uh, yes, Abdul. So uh, I have tried. So see, there is a lot of ideas on the table, right? So you just mentioned 3, 4 wonderful ideas here. So there are a lot of, at any given point of time, there are a lot of ideas to work on. So I have not, for example, for lack of time, right? I tend to look at it as okay, ये open offer है. I will not get my emotions mixed up, and I will exit it after the open offer plays out, right? So I have not paid attention to what you have said. That what happened after that. So that part I've not paid attention. Abdul. Maybe that's a mistake that I'm doing, but I'm just saying that right now I'm not done that.
Okay. In my part, I definitely think that I have committed that mistake in some
Okay.
cases.
Okay.
Yeah.
But
And one more resource
here's the thing, right,
I want.
Abdul? Sorry. I was just saying that you can do that, but again, it's a question of opportunity cost. Achha, so if you're going to study this company, then there is another company which you're not studying. So there is that opportunity cost which comes with that.
Agree.
I have a very good example for this, Avdut. See, Vikas is a master in special situation, and he has been doing it for 3, 4 years now. And I have discussed a lot of special situation with him. And in fact, whatever little I know about special situation is only thanks to Vikas. But I have stayed away from special situation over the last 2 years. I have not. I participated here and there in one or two. But I'll just give you one example. In case of this Tata Chemical and this one Tata Consumer demerger, okay. So when Vikas is investing in that kind of a situation, he is putting his hat of a special situation investor. And when I looked at that kind of, when we at Smart Sync Service, not just I, Akhilesh, myself, and Karan, when we were discussing about that opportunity, our idea was more on understanding of the business of Tata Consumer. In fact, at that point of time, it was Tata Global Beverage. So, what kind of possibilities we can see? And there were several other triggers in terms of management change, Chandra coming in, making many changes. So you can't compare these two things, whether what will work out or not, that these are completely two different sets. And if you will compare like that, you will always get confused, right? So you should be very clear which boat you are in, right? After, so that is why I told in one of the questions that you have to first, when you are entering into this, first of all, you have to exit when the event is over. And then probably you can look at it with a fresh pair of eyes. But यहाँ पे क्या हो रहा है कि you are talking about the stocks which you missed, as in they went on to become multi-bagger. But there will also be cases where the stocks didn't do well after the event. So you don't. So हमारा जो the way we look at investing is we'll always crib about the multi-baggers we missed. We will never be thankful about the landmines or the landmines which we luckily escaped, right? So that is also one thing which we need to look at.
Ankit bhai, what you are saying is correct, but I'm not saying about all the situations. Just few situations where we know who is going to buy. So for if I look at my point of view, how I look at any open offer or any special situation is, first thing is I look at who is going to buy it. If the guy who is going to buy is having capabilities, then only I decide whether I should go for long term or not. Plus whether that guy is financial guy or the guy is into the relevant field. If that is the CVC capital or something like that, then I will probably stay away from it. But like I mentioned, Escorts taking over Kubota, then they are into the relevant fields. Then that process will start whether I should look at it at long term or the short term. But now at Smart Sync, I can say we have Vikas and you. Then we can look at it from both the perspective going further, right?
Right, Abdul. So, Vikas, there is a question from Neeraj on takeovers. So you are saying that, asking what are your views on takeovers, like the imminent India Cements corporate action. So have you looked at it, Vikas?
Yeah, so takeovers will also come under. Um, so like I said, the example I gave was Reliance taking over Just Dial, right? So if Reliance is going to buy more than 25% of the shares from the promoter, they will have to make an open offer. So are you invested in? So for example, the question to ask is, are you invested in Just Dial uh, as a long-term investor, or are you invested in as a just for that open offer? So I was invested in it for the open offer, right? So now my question back to Neeraj would be like, are you when you say takeover, are you want to play the open offer or you want to be there for the long term?
Yeah, I'm just asking from the perspective of the takeover.
The open offer, right?
Open offer, yes.
Yeah. So do you know at what price they want to do the open offer?
No, I think nothing has crystallized yet, but
So then that is the thing that I would avoid, right? So I mean, I would avoid. You're free to do what you want. So, for example, I want that announcement to have been made.
right, okay.
Otherwise, it becomes a speculation for me.
Fine.
I think Gaurav Sood made this point very clear in his presentation in IIC, right?
Yeah.
That you want, and that is where we learned about it. That you have to be very sure that this is going to be happen, and you don't speculate whether this will happen or not. Like a very good example, Vikas said that you can't invest in ITC today thinking that okay, that demerger will happen. So once that demerger announcement is being done by ITC, then you can look at ITC as a demerger play.
Yeah.
Sure.
So friends, do think about this concept of opportunity cost, right? See, you are investing time and money in one particular idea, right? Which means that that time and that money is unavailable for any other idea at that point of time. You're blocking that resource. So it's a very precious resource that you're blocking, right? So you want to you want to invest it where the risk reward ratios are in your favor. And if you go into things thinking something might happen, you will be blocking that resource. And if that event does not play out, then that's a waste of your resources then. So think of it that way. And everything, even what Avadut is saying, right? It'll again come down to that opportunity cost. So you have to know, okay, if Max looks interesting despite the special situation, if I want to look into it, then be aware that you're giving up something else. And you should be okay with whatever you're giving up.
Because
You have two different portfolios, like Vikas has mentioned, that one portfolio of Vikas is a special situation portfolio, and the other one is the long-term portfolio. You should be very clear in which portfolio you are having that company, and if there is a situation where you want to shift it from, say, a special situation to a long-term portfolio, you should actually do it. Then only you will have that clarity. Otherwise, these things can become very confusing, and in the long run, the law of averages catches up, and you get stuck.
So friends, it is just a thing for me. It's like I'm having some thrill here. Okay. Otherwise, my day would be very boring. So just for some this one, I'm very clear that my opportunity cost is there, and so for me it's 18%. If it is more than 18%, I'm willing to go at. So even though there could be opportunities in the long term, which will probably give me more than 18%, and therefore I should invest more time and effort there, I'm willing to forego that to do some special situations. That's the way I'm looking at it, and I'm okay with that.
Vikas, I have a question now for you. So now that you have around 3 years of data with you, how you have performed in special situation, and the IRR which you have got, this is 33%, is quite impressive. So are you not tempted to increase your portfolio allocation to special situation bets, or you would?
Yeah, one thing, okay, so one thing I forgot to mention is with special situations, the law, hidden law seems to be like the returns are proportional to the amount of effort that you put in, right? Or the amount of intelligent effort that you put in, right? So it takes quite a bit of effort to uh, find these, track these, do your own homework, come to your own conclusion, and so on, right? Um, so that is why I have limited it to a few in a year. I can do maybe 4 or 5 in a year, not more than that. That is what I have realized. So I'm quite tempted, Ankit, except that where I think we can make some money, those don't come every day. Okay. And second thing is, I got lucky with a few special situations like Prabhat and so on, right? Where despite corporate governance risk, we made some money there. So if you take away those things, the IRR will not be so high, Ankit. It will be in the 20% range, maybe 15-20% range. So I will still continue to invest maybe 10% of my time and money in this. Uh, the but the great long-term opportunities don't come every day. So I would still say only 10% here, Ankit.
Very good, very good. Thanks, Vikas. This was really helpful. Yeah. So anybody else, even though it's 1 p.m. now, if we have any questions, we'll take it up. I hope, Vikas, it is fine with you.
Yeah, I'm perfectly okay, Ankit. And so, friends, I mean, it's your personal opinion. You might not want to share it in the group. If you feel I've not done any justice to your investment today, please get in touch with me.
Because open offers that have actually worked out in terms of IRR, which have generated 20 odd percent in your terms, because of late I haven't like something which I've skipped or anything in the open offer category. Because I don't feel that once the price is announced, they usually just check out the market price and probably in that range only they announce the open offer sort of a thing. So any specific instances?
Yeah, you're right, Dhruv. So I keep scanning for open offers and I don't find too many of them. Okay. So whatever I find, the price is already shot up over and above the open offer price. So I skip all that. So friends, if you I'll just show you where to find open offers. I kept this ready. On my screen, I've just gone into the SEBI website, and under filings, you will find takeovers and you will find letter of offer. Right. So, for example, you have all these ones which have filed their letters of offers, right? And you can just go into, say, any one, and then you will find this draft letter of offer. And this will tell you all the details about that particular open offer. Right? You will know about the timelines, the offer price, everything you will know, right? And so this is the schedule of all activities that have been mentioned, and there's a time window. So the open offer of opening date. So between Feb 10th and Feb 23rd, they will be. You can submit your shares here. They will be buying it. That's what it says. And if you find the offer price somewhere here, offer price and financial arrangement. So you will know what is the price that they're going to pay you per share. Okay. Uh, just give me 1 second, friends. Yeah. So here you go. So there is a formula for calculating the open offer price. It is the greatest among the these four, 1, 2, 3, and 4. So so the final offer price that will be paid is 11 rupees 50 paise. Now you need to check if the share price of this company is below 1150 or greater than 1150. So if it is less than 1150, like the way I found for Lycus and international conveyors, you can participate in this. So the other thing is you might worry, okay, this is an unknown company, will I get my money? The answer is yes. This is a SEBI process. They have to, so this money will come from an escrow account. So that money would have probably been kept in an escrow account, and as you tender your shares, you will get the money. So this is how you play an open offer. So this is there on the SEBI website. Sorry, what is the question somebody was asking? Dhruv, yeah, Dhruv. So usually even I'm not finding any great open offers at the moment. But when I find one, I would like to buy it.
My personal experience is not on the other things which have worked for me on special situations. One is something which wasn't covered was capital reductions. In terms of capital reduction, what happens is they announce the stocks gets delisted and then it again gets relisted, and again it's not usually covered by the market because finding out that intrinsic value at what price it's a good buy, this that it leaves a lot to be desired out there, and
Okay.
worked out there. One was X, which was a good one. Another was 3i Infotech, which was a recent one.
Which
and
was
there's
the?
a Bombay 3i Infotech and Subex. These two had undergone capital. The third one, which is going to get listed tomorrow, is the Bombay area. Usually, you'll find these companies in the micro cap space, so not in the large cap. And usually, they will have some issues because only then they undergo capital reduction. But it works because again, it is not tracked by the market, so it leaves a lot to be desired. And secondly, is in the demerger space, where a lot of times. So the demerge company is so small. So what happens is because the demerge company is small, a lot of these institutions have to sell it, and the price goes down post listing. The best example which I played was RT Surfactants. So from the RT group, it got delisted at 500. It opened, it went down to 250 because all the mutual funds had to sell it because they can't hold a share which is below a particular cap. So they sold it, it went down to 250, and then it just went in circuit till 1000, and then then it opened. So I exited there. So demergers usually make that play much better because a lot of times these institutions have to sell off the demerged equity compulsorily. And I think it might play out in GMR also, although GMR you don't have too many institutions out there.
Yes, yes.
Third thing a lot of people were talking about the allocation. So the way I allocate is I like to, so the escorts thing, and they were open offers, but GMR, NMDC, the way I am playing is they have fundamental themes in themselves apart from just the open offer or the special situation. So you can allocate extra. Open offer is just more, or a special situation is just more a kicker for your portfolio IRR, which can play out. You can give a proper portfolio allocation to these stocks because they will generate a decent return for you. NMDC to be, so you have a different tailwinds for the stock in that sense. So yeah, and even GHCL I had considered at one point of time because the company was good in that sense.
Yeah. Thanks, Dhruv.
Thanks. Those were really good points. Yeah. Vikas, there is one question which is still unanswered on the chat box is, I think Neeraj asked about India Bulls real estate merger. So have you looked at it?
No, I've not looked at it. Sorry.
Vikas, like Dhruv mentioned about the institutions selling and being a smaller part, we also discussed it.
Yes, yes.
There is one resource, or I would like to mention. Ankit Bhai mentioned about the Tariq's dashboard. Tariq and Ish Mohit had done one webinar on special situation. I think whether it is available on YouTube, I will check it. If it is available, I will share the link. It was a good one to how they play it, and how they were discussing about Piramal Pharma, which part will become a smaller one and
Yes,
which part
yes,
become a larger one, and how they would like
yes.
to play about it. That was also one very good resource. If I get that
Yes,
YouTube link, I will definitely share with Ankit Bhai
sure,
or on the group.
sure.
And I think if it is not, then it will be for SOIC members. He would have done it, that webinar.
Sure, sure, sure.
It was
Sure, Abdul.
earlier there. I will check if it is available. I will share the link. And thanks to Dhruv also. Very good insights. Thank you, Ankit Bhai, and thank you, Vikas, for your good insights. And I
Okay.
would going forward also, I will like to learn your approach of buying it earlier, and it is the other way around what I normally do. So I would like to learn that approach.
Sure. Thank you, Avdut. Thank you for
Thank you.
sharing your insights on this.
Thank you.
So, friends, I forgot to, this was going to be my opening line, but I forgot this. So, I will say it by now, you would have realized it. So, I'm not like Professor Special Situations. I'm more like, you guys know a lot. I also, I'm just sharing whatever I have experienced in the last 3-4 years. So, it's not much, but whatever it is, I've shared it with you today. Thanks.
Because you are being too modest here, but okay, we'll leave it at that. But if anyone has any question, we can take it right now, or then we'll call it a day. Then it's 1:10 now. Anyone? Okay, so because I guess there are no more questions.
Ankit
Thank
Bhai,
you so much.
Ankit Bhai, one last suggestion. If you guys can, Nalanda Capital's Amit Patil has written one book about mergers and acquisition. I am reading it. It's an excellent book. Whatever I have come across about special situation, everybody should read it. I have just started reading it. I would definitely recommend it. Ashish Patil of Nalanda Capital, and the book's name is Mergers and Acquisition.
Abdul, you can
Wow.
probably put it on the Slack channel as well, so that it gets registered for everyone.
Yeah,
Okay.
definitely.
Thank you so much, Abdul. So thank you, Vikas, for your generosity. You spent a lot of time preparing for the presentation and then answering all the questions. And thank you to all of you, specifically Abdul, Dhruv, both the Dhruvs, and other people who asked some really relevant questions. And it was definitely a very interactive webinar, and we all learned a lot. So I hope we have more such webinars in future as well from Vikas. And with this, Vikas, would you want to say something before we sign off?
Yeah,
Or?
thank you, Ankit, and thank you, Karan and Akhilesh, for giving thank you very much.
Thank you. Thank you so much, everyone. Bye-bye.
Bye.